Hello, friends. Welcome to the program. My name is Joel Garris of Nelson Financial Planning, and you're listening to Dollars and Cents on News Radio WFLA in Orlando. On the program today, we're going to ask the question, what's with all this optimizing of Social Security? We see the internet rife with a bunch of calculators out there for you to help determine when's the best time to take Social Security. And my goodness, it seems that every one of them has the same conclusion. And guess what? We're going to suggest that perhaps that conclusion isn't the right one for you. So stay tuned on that. We'll also talk about whether in today's world you can still really make a charitable contribution and ultimately get a tax deduction for it. Plus, is the shotgun approach to investing really a good approach? If you're using sort of that spray method to make sure that you've got all the boxes covered, that may not be the best approach. So we'll talk about all of that on the program, as we've done each and every week now for well over 30 years. Started way back when by my father-in-law, Jack Nelson. The tradition continues today by me, yours truly, Joel Garris of Nelson Financial Planning. So let's dig into it, shall we? So, ton of calculators out there on the internet that are all geared to Social Security optimization. And we've played around with a number of them just to kind of see how they work. And at the end of the day, they all seem to kind of come to the same conclusion, which is that if you delay as long as possible and live as long as possible, that, in fact, is the way to get the most amount of money. Well, I don't know that you need a fancy internet calculator to tell you that. Delaying Social Security means that your amount that you're going to get goes up. And whether you're delaying to get to your full retirement age, to get that amount that's on the front page of your Social Security statement, because when you get those Social Security statements in the mail, folks, the amount on the front page is the amount that you're going to get on your full retirement age, which for many is shifting from 65, 66, 67. So you need to make sure that you're reading that statement properly and go to page 2 where they will have down what your full retirement age is. Maybe it's 66 and 2 months, 66 and 4 months, 66 and 6 months. You get the idea. It's based upon your date of birth. So if you don't take it at 62 and wait till your full retirement age, well, obviously that's more money. If you further delay it past your full retirement age, it continues to go up by about 8% per year all the way until age 70. And at age 70, then there's no extra amount that you can get. So all of these calculators online take all of that into consideration, and to get the most amount of money out of Social Security on a monthly basis, then you would wait. That is very obvious. It's self-evident based upon how the program in fact works. However, if you then look at sort of where that point is in terms of how long you have to wait in order to make that money back, well, that's a different conversation that these calculators don't really get to. We've got one here that we were messing around with, and the conclusion or the thing that pops up sort of on the screen that gets your attention is how they all kind of operate when they're trying to optimize. And they'll say, like this one in particular, good news, right? Good news. we found your client $61,566. It's like money that it's out there. The problem is when you start turning the pages. So don't let sort of the front page conclusion on these calculators lead you to something that doesn't make the most amount of sense from an economic perspective, because you can't run these Social Security optimization calculators in isolation. You can't work in a bubble and just look at those numbers and run those numbers, and then those are the only numbers that, at the end of the day, that you're going to base this decision off of. Because the reality is that there's something far more important. And when you just use this example that we used, had someone that was age 65 and spouse that was age 66. And so the 65-year-old husband was going to have a Social Security benefit of about $2,500 at full retirement age, and then the spouse was going to have a benefit of about $1,500 at full retirement age. So when you ran the numbers on it, that's where that conclusion of, we found an extra $61,000. The problem is that when you go to the really details, the spreadsheet-looking stuff of this, and usually these reports, this is a 12-page report. Usually these reports are multiple pages with a bunch of information buried in there. So if you kind of look at the front page, you're going to get a very different conclusion than if you kind of go to the meat of it. So this one, just like most of them out there, optimize, maximize strategy, wait as long as possible. Husband waits till age 70 to start to collect. Wife waits as well. And so they wind up not starting to take any money out until the year 2024. Okay? So that's 5 years from now. And at the end of the day, then if you look at sort of a specific strategy that would say, okay, why don't we look at, what happens if we start taking it now? And maybe for the wife, she waits until her full retirement age. But here are the numbers. So he starts taking it now. He gets a reduction so that his Social Security benefit is only about $2,400. Remember, he's 65. His full retirement age isn't until 66. So he's taking it early. He's even taking it earlier than his full retirement age. By the time the year 2024 rolls around, they will have received a total of $186,000 of income. Meanwhile, if you go to the maximization strategy at the end of 2024, because they will have just gotten one check, because this particular individual his birthday was in December, so they would have gotten one check, which was basically $3,400. So stop and think about that for just a second. First 5 years of retirement, where are you going to get the $183,000? Where's it going to come from? We'll continue the conversation when we get back. This is pretty important stuff, and why the screen that pops up when you run these Social Security optimization calculators is incredibly misleading in light of the rest of your picture. So we'll continue this conversation when we return after these messages here on Dollars and Cents. This is Joel Garris of Nelson Financial Planning, News Radio WFLA Orlando. Welcome back, ladies and gentlemen, to Dollars and Cents. This is Joel Garris of Nelson Financial Planning, having a very in-depth conversation on the program today about Social Security optimization. Ton of calculators out there. When you plug the numbers in, you get the same thing that I got, which is good news. We found you extra money. The problem is that you can't run that analysis in isolation of everything else. Because if you compare the optimization strategy, which is always wait as long as possible and delay and live as long as possible, and then you'll wind up with a bunch more money, and where that front page number comes from is it looks at delaying for the next 5 years until everybody gets to age 70 versus taking early and then running the numbers out until that couple is 85, 86 years of age. And then it compares the amount that you would have collected over the course of your lifetime, which in this particular example was $990,000, to what you collect over the course of your lifetime if you started early. Because remember, when you start early, then you're getting less than what you would have by versus waiting. So that lifetime amount comes in at $928,000. So that's roughly the $60,000 difference that you could find, extra money you could find if you went with the optimization delay strategy and, live to 85 kind of thing. The problem is that let's go back to some of the more important numbers, which is the first few years of retirement. What most people don't realize is that the first few years of retirement are, in fact, typically where you're spending the most amount of money. Why? Because you're younger and you're more able to do stuff. So if we look at the first 5 years between now and 2024, well, you're not going to get anything from Social Security, $0. Versus if you start it, you're going to get a total of $186,000. Well, that money's got to come from somewhere. And you mean to tell me that the answer is going to be, well, for that $183,000 that I need in the first 5 years of retirement, I'm just going to hit my retirement accounts, I'm going to hit my investments, I'm going to hit something else. Really? That doesn't make sense. The money's got to come from somewhere. And the reality is that all of these optimization strategies don't really have the effect of inflation in there, don't include the effect of where's that $180,000 coming from in the first 5 years of retirement? What is the impact that that's going to have on your entire picture? Because you're going to have to get that money from somewhere, all things being equal. So be careful with these optimization strategies. Be careful with these presentations that come from these calculators that say, wait as long as possible and live as long as possible, and then you'll find an extra $61,000 pot of gold at the end of the rainbow when you're 86 years of age. Problem is, in the first 5 years of retirement, you had to blow through $180,000 plus in order to get that money, to have that money. Using the very simple example that we used here. This is an individual, $2,500 is their full retirement amount at full retirement age. Spouse, it was $1,500. Very typical type of couple that you will see in today's world, where one spouse kind of worked the entire time, the other spouse had some years off to raise kids, things like that. And so consequently, that's very typical, those kinds of numbers. But be careful, because somewhere along the line, you're going to have to answer the question of where am I going to get the $180,000 that I gave up by waiting 5 years? In this particular example, that's a pretty big difference. And okay, fine. I have an extra $60,000 if we both make it to 85, 86. But the problem is that the effect or the impact that you put on other assets to get to that point seems to me that that's a whole tremendous amount of impact to put on your overall picture. And by the way, if you're wondering where these lines ultimately cross, it's in the year 2036. It's a long time to be behind the 8 ball on these numbers. So be careful on that. Make sure that the decision that you're making when as it relates to Social Security takes into account your entire picture. Because that need for money in those first few years of retirement, that's where it is, in fact, much more important to be able to get access to money during those first few years of retirement. So certainly something to think about, a little bit against the grain, as we like to do here on the program on a regular basis, because a lot of the stuff out there we think is pre-programmed and intended to not give the best possible advice. It's intended to give the most conservative possible, delay it, wait, live long. Oh, I'm sorry if you died early and this whole thing blew up. No. Make sure you make that Social Security decision based upon the entire financial picture and not just based upon some silly headline or conclusion that says, hey, we found you some extra money. Found you some extra money, but you're going to have to get a whole bunch of money from someplace else in the first few years of retirement. Seems to me that that's not a good idea. Speaking of things that require a little bit more thought these days, this question comes to us through our email bag. A viewer suggested that we chat a little bit about how, in fact, valuable is a charitable deduction in today's world. This individual was thinking about making a contribution to his church for a new roof, 10, 20,000, relatively substantial gift, and was wondering what exactly is the impact or the benefit from a tax perspective. So let's recap where the rules were and where the rules are now, because that has sort of shifted in terms of people's perception about charitable deductions and the ability to write them off. So the old rules, the standard deduction was much lower. And so that meant that more people could itemize. When you itemize, you add together all of those different charitable contributions, mortgage interest, real estate taxes, medical expenses, all that kind of stuff. And because the standard deduction threshold was lower, then that meant a lot of people were able to itemize, and they were able to see, oh, the fact that I gave this extra money to charity that I wouldn't normally have done, oh, that got me an additional write-off on my taxes. And that was pretty straightforward. Now, with the standard deduction jumping up to $24,000 for a married couple, $12,000 for a single person. If you're over 65, you even get a little bit higher standard deduction on that. More and more people are sort of questioning that. Well, you can certainly still make a charitable deduction and still itemize. It's just that it's a little bit harder for most people that were doing that to get across that much greater threshold. So it really involves sort of looking at your taxes in order to quantify how much of a benefit that's going to get. At the end of the day, when you make a charitable deduction, even in the old rules, you were only able to write it off and save based upon your marginal tax bracket. So if you're in the 25% tax bracket, you make a $10,000 gift, you're going to save $2,500 on your taxes. You're not going to save $10,000 on your taxes. Okay, so you only were getting a portion of that as a write-off on your taxes. So we're going to slide to a break. When we get back from the break, we're going to kind of flesh this issue out a little bit more and give you a very specific suggestion as what you could do to help maximize out that charitable giving on your tax return. So we'll do that when we get back here on Dollars and Cents. This is Joel Garris, Nelson Financial Planning News Radio, WFLA Orlando. Welcome back, folks, to the program Dollars and Cents. This is Joel Garris of Nelson Financial Planning, listening to News Radio, WFLA Orlando. Talking a little bit on the program today about charitable contributions. The topic comes to us courtesy of the email in-bag. And the question is, if I make a contribution to my church, am I really going to save money on my taxes? Can I still do that? The answer is, of course, yes, you can do that. But to get a direct benefit on your taxes, it's a little bit harder because there's a bigger threshold in which you have to cross. So certainly the ability to make a contribution to a charity and write it off still very much exists, but the question is whether it's going to make a difference on your tax return. And it's harder for that to make a difference because the threshold that you have to get across, which is basically the standard deduction, is much higher than it used to be. So you may not get as direct savings on it as perhaps you did under the old rules. So it's one of those things where if you're thinking about making that charitable deduction, you want to see, okay, well, am I close to the threshold? Where am I? Am I over the threshold? How much of a difference is this really going to make? You've really got to look at your tax return and particularly look at last year's tax return when the rule was, which was the first year that the rules all changed, and see, okay, did I wind up taking the standard deduction last year? And how far away were my itemized deductions from that standard deduction? If they were close, then okay, great. If I give an extra contribution to my church, then it's going to make a difference. But if it's not that close, then it's not going to move the needle on my tax return. That's just the way that those tax changes played out across the board. There is, however, one very important tool that is available to you if you are taking your required minimum distribution. If you're taking your required minimum distribution, meaning you're over age 70 and a half, you've got to take money out of your IRA, what you can do with your required minimum distribution is something called a qualified charitable distribution, a QCD. And that's actually the letters that you have to put on your tax return in order to alert the IRS that, hey, this is something that I did. So what's a QCD, a qualified charitable distribution? It basically means that you tell your IRA custodian, don't send me the required minimum distribution, send it directly to the charity. It's important to observe that procedure because if it comes to you first and you just write the check to the charity, that's not a qualified charitable distribution. A qualified charitable distribution has to go from the IRA to the charity. And if that's the case, then regardless of whether you're itemized, regardless of whether you take the standard deduction, you get to offset the entire amount of that income from your tax return. So let's say your required minimum distribution is $20,000. You make a $10,000 qualified charitable distribution. You only need to report $10,000 of that required minimum distribution as income on your tax return. So that's a pretty powerful way to get the benefit from the charitable contribution regardless of whether you itemize. So that's a technique that we encourage more and more people to take advantage of, particularly in light of these tax changes. That's a way to make sure that you're getting the most impactful benefit on your tax return when you make a charitable contribution. But you got to follow the proper process on it. And that is, it's got to go check from the IRA to the charity. Not to say that you can't have the check mailed to you first so that you can hand deliver it to the charity, but that check has got to be made payable to the charity. And if that's the case, then you're in good shape and able to take that qualified charitable distribution. So some pretty powerful stuff in terms of being able to allow folks to get a tax benefit directly when it comes to making a charitable contribution. Also, courtesy of the email in bag, we will tackle this one. This is an email from Michael. It says that there's been a lot of commercials lately about selling your life insurance policy. Is there any advantage to selling your life insurance policy? This particular individual, Michael, never owned life insurance, was offered it as a group benefit when he was still working, but hasn't really needed any life insurance. Many of your older listeners might be hanging on to these policies when they probably shouldn't. What is your advice to them? Great question. The first comment I would say is generally if you are retired, hopefully you have properly planned before you're retired, and that means you've got sufficient assets and sufficient income coming in that the need for life insurance does start to decline. We think of a life insurance as more of an income replacement vehicle. In retirement, you should have retired with enough assets and enough income where if you die, the assets, the income would still continue on in some form and fashion. Obvious exceptions to that, if one spouse chose a pension that is based solely upon their life expectancy, then that is certainly a very different conversation, because that income would completely disappear. But if you think of life insurance as that income replacement vehicle, then certainly life insurance is good to have when you're younger. Maybe you haven't accumulated enough when you're early in that accumulation phase, so that if anything happened to you, then at the end of the day, there would still be money to help to generate some income that would cover your income that now isn't happening because you're dead. I think the best policy to use in those particular types of circumstances is a term policy. A term policy basically lasts you for a period of time. The premium is much lower, and it really does serve that function of income replacement, because the point of that is to have it during that accumulation phase while you're accumulating assets. Once you've accumulated the assets, then the life insurance becomes less of a need. So that's just some general comments on life insurance in general. I think Mike's question is really more about these whole life policies that are out there where there is cash value in them. And so there's a lot of folks that are advertising, oh, we'll buy your life insurance so that you can get some money now, and then we'll collect the death benefit. Typically, when I see those numbers, you're really getting squeezed in terms of how much money you're actually going to get from the sale of that life insurance policy. But as with anything, just as we said with the charitable contribution and the effect that it has on your tax return and whether you're going to save taxes or not, same thing is true here. You've got to look at the numbers. You've got to run the numbers in order to make sure of what that decision is going to be. Generally speaking, Michael, I would say I would be reluctant to sell a life insurance policy, because oftentimes you're just not getting back what you could have gotten had you continued to hold the policy. There's ways to get money out of a whole life policy, whether it be through loans, although we're not a particularly big fan of it. But if you're desperate for money, one option could be a loan as well off of that policy. And maybe at the end of the day, depending upon how much you're getting offered, you look at, okay, wait a minute, how much is that cash value? And could I just take the cash value and use that and then avoid having to make the premium payments going forward? So the conversation of what to do with a whole life policy, a la the commercials that you hear out there in terms of somebody willing to buy it, is a little bit more complex than, oh, I'll just, throw it in for a quote and see what they say. No different than what we were talking about on the program earlier about the whole Social Security optimization, right? Run the numbers. That's the important thing to do when it comes to making any financial decision about anything involving your money. We'll come back for our last segment here on the program, Dollars and Cents, after these messages. This is Joel Garris of Nelson Financial Planning, News Radio, WFLA, Orlando. Howdy, folks. Welcome back to the program. Joel Garris here of Nelson Financial Planning. You're listening to Dollars and Cents on News Radio WFLA Orlando. That is, if you're listening to the program between 9 and 10 a.m. on Sunday morning. If you're catching it after that time period, well, then you may very well be listening to us on any one of our podcast channels. If you're curious to see if we're on your favorite podcast provider, chances are we are, double check our website at nelsonfinancialplanning.com. In the upper right-hand corner, you'll see a bunch of icons. Click on the one that you're most familiar with, whether it's Google Podcasts, whether it's iTunes, whether it's iHeartRadio. They love it when I say that here on the program. Or if it is any of the number of other podcast providers out there, it's all there as an option for you to take a listen to. And then, of course, on YouTube, we put a full video of the program on YouTube as well. Started doing that a few weeks back. And I think each and every week we kind of improve the quality and the connection on that video. So check that out as well. We've actually got a channel on YouTube, Nelson Financial Planning channel on YouTube. So you can go there and subscribe. And when you subscribe to any of these podcast channels or YouTube, what happens is you get an instant notification when the program gets uploaded. So if you're interested in catching it during non-air times on the radio waves, there's plenty of options in which to choose from. So check that out. And speaking of options to choose from, be careful if you're using the shotgun approach to investing. Folks, we see this all the time, okay? Just so many different asset classes. I had somebody else the other day showing me a pie chart that was divided up into 32 different pieces. At some point, the desire to get diversification undermines the ability to have a sound strategy in terms of what you're doing with your investments. The shotgun approach of, hey, you own everything, at the end of the day, still has to balance itself out. When you're creating an investment allocation, when you're creating an investment portfolio, you've got to strive to get to a certain level of risk in that overall portfolio. There's a bunch of ways to measure risk. I can throw out some technical terms here, standard deviation, beta, alpha, blah, all that stuff. But the reality is that that's what determining an overall investment mix is all about. And if you simply use a shotgun approach, you're saying, okay, you're going to have small companies that are dividend paying, you're going to have small companies growth, mid-sized company, you're going to have international, you're going to have emerging market, you're going to have all these different types of things, asset classes that are out there. At the end of the day, you've still got to get to the same balance in terms of the overall investment mix. So what happens is the more smaller companies or mid-sized companies or the more emerging market companies you have, it means that you've got to increase then the bond component to offset that in order for the entire portfolio to have the same risk characteristics. If I'm using stuff that's got more volatility, then at the end of the day, I have to use stuff that has less volatility in order to sort of balance that out from an overall perspective. Well, the question we ask is why? Why do you have to do that? If you're introducing a piece into the portfolio that you then have to over here, on this other hand, offset, why bother to introduce that piece in the portfolio if you're just offsetting it on the other end of the day? Aren't those things going to essentially cancel themselves out? They do. And that's what happens. And that's why we think that shotgun approach of owning all of the different sectors out there, of owning 32 different slices of a pie when it comes to your investment allocation, it isn't really the most efficient way to go about it. If you look at what you're able to do when you're far more selective in terms of the companies that you own, then in fact you might very well not have to own as much on the bond side of things to cancel out the behavior of stocks that are more volatile. So it's important to really look at the quality and the nature of the stocks that you have. Because at the end of the day, if you're conscious of that, then you might not have to own as much on the bond side. And so consequently, you get to a better rate of return over time by not having to be as heavy on the bond side of things. I think far too often, the world at large uses very simplistic formulas that have to tick every box and have to have X% in bonds, and here's the portfolio, and it's all running off of a software, and it checks the box and it ticks the box, and And we've been talking about this a lot on the program lately. You know, those are the lawyers determining your investment allocation. That's not a financial person determining your allocation, because the lawyers are basically saying, well, we can't have, it's got to look like this because at the end of the day, it's got to all balance out. Well, forget that. If you're more selective in what you own, then you can have a portfolio that's going to be focused more on good quality companies. We talked about this last week, how to recession-proof your portfolio, particularly after this past week, which wasn't a particularly great week in the market. You may be asking that question. It's a rough week in the market this past week. One of the things, though, that you can do, as we talked about last week on the program, is really look to make sure that you're owning good quality companies. That, folks, is far more important to serve as the basis of a sound investment allocation rather than, I'm just going to own everything. This is my pie chart, and it's got 32 different slices in it. What's that going to do for you? And great, you got everything covered. It's all working, offsetting, balancing out each other, and at the end of the day, you're not necessarily going as well as you could from an overall investment perspective. So make sure you check that out when you're looking at your investment allocation in your portfolio. Make sure you take some time to really dig down into what that mix looks like. If it's 32 slices in the pie chart, probably you're overshooting on the diversification and ultimately reducing your potential rate of return over time. So certainly something very important to look at in terms of what that overall mix looks like. That shotgun approach of owning everything, we just don't think it works as well as people think. And when we look at the numbers, that's why we come to that conclusion. When we look at performance numbers over time of a more specific investment allocation that looks at owning good quality companies rather than that shotgun approach, we see time and time again where the performance is, in fact, better over time. So certainly something to be thinking about as it relates to your investment portfolio and making sure that you're on the right track. Well, we will wrap it up for this week. Hard to believe how quickly the hour goes, right? But we are wrapping it up this week here on Dollars and Cents. We'll be back next week with another litany of conversations to talk about. If you're interested in getting your topic on air, don't hesitate to send us an email during the course of the week. That email is my first name, Joel, Joel, at NelsonFinancialPlanning.com. We'd love to talk about what's on your mind during the course of the program next week. In the meantime, have a great week ahead. This has been Dollars and Cents with your host, Joel Garris of Nelson Financial Planning on News Radio, WFLA, Orlando.